So, Karan, I want to start by understanding you often say that when it comes to the more active styles of investing,
Hmm.
right? Alpha is, rapidly disappearing from that. I want to understand firstly, why do you say that? Like what is the basis for that logic?
See, yes, let's go a bit back into the history. In the 1990s and even in early 2000s, if you want to take exposure to stock market,
Mm.
okay, in general, either you have to go and pick the stocks yourself,
Hmm.
or you have to rely on a mutual fund.
Right.
Okay, things started to change in 2001 when Nifty Bees was introduced. Okay, that was the first ETF which
Correct.
was tracking Nifty 50 benchmark.
Right.
So today there are some 406 index funds and ETFs which are
ETFs.
there
Yeah.
in the market. Okay, and nearly 40 products which are tracking
Mm.
Nifty 50 index.
Okay.
Okay, so getting market returns is quite easy.
Right.
Okay,
Right.
there's no brain need to be applied, no selection need to be done,
And also
and
your
they're
expense
also, yeah,
ratios are
expense
pretty
ratio
low.
is quite low. They are
Yeah.
available at a fraction of price. It's very easy to get market returns. So if you are going to any other instrument,
Mm.
let's say mutual fund,
Mm.
doing direct stock selection, PMS, AIF,
Right.
anything,
Mm.
anything, small case you can say.
Mm.
Okay, so anything you are going for, alpha. You
Correct.
want to beat the market and create some additional returns. That's the
Correct.
motivation. And 90% of these alpha products that you talk about, which are designed to create alpha,
Hmm.
are managed through active style of investing. When I say active style of investing, that means there is a manager
Right.
who is taking a market call.
Who's
Okay.
consciously deciding what
Decide,
is
okay, what to
right.
buy, when to buy, based on his research,
Mm.
his belief, and his
Mhm.
conviction.
Right.
Okay.
Mm.
So, thing is that these managers basically do their own research,
Mhm.
okay, and identify market anomalies, okay,
Right.
market discrepancies,
Mm.
pricing discrepancies, we can say, which
Mhm.
they exploit to create alpha for the investors.
Right.
Okay,
Right.
so mutual funds typically go for stocks which are undervalued
Mm.
as per their
Mm.
research. AIS can play both side; they can short as well.
Short as well.
Okay,
Right. Mm.
but the thing is, if you look at the data, especially the mutual fund data, you will see that typically, if when you're going for this kind of product, you're looking at an annualized alpha of around 1 to 3%. Okay,
Okay.
in general,
Okay. Okay.
to make sense.
Right.
Okay, most of these mutual funds, if you look at the large cap data for large cap funds, mid cap funds, they're struggling to create even 1% alpha over the last, you can say, over the last 15 years. And I'm talking about 10-year rolling data. Okay,
Okay.
so if you take the rolling data from starting from 2015 to 2025, 10-year rolling data, there's a hardly any alpha that has been created in large cap and mid cap funds. Mid cap funds, alpha was there till 2015, but it has largely disappeared now. Okay,
Right. Right.
so thing is that it's not abnormal thing. Okay, it has happened past in other markets as well. It's not
Mm.
that managers are not capable of creating alpha. It's just the markets have changed.
What does
Okay,
that mean? Like,
S-
why does this
so
happen?
basically, what happens as retail participation increase in market, research coverage also increase in the market. Okay, and there's a spike in computational prowess in recent times. Okay, thanks
Mm.
to
Mm.
technological progress.
Mm.
Okay, so there are these market anomalies that were bread and butter of these active managers.
Right.
They are quite rare and
Mm.
difficult to spot. And even if they are there, they get corrected quite quickly
Ah.
without giving
Okay.
managers to exploit them. Okay,
Okay. Okay.
okay,
Okay.
and it's not like that. It's happening in India only.
Mm.
It happened in US some 3 decades ago. Started happening in US some 3 decades ago. If you look at the data that is published by S&P on regular basis, 90%,
Mm.
I would say 95% of large cap strategies underperform their benchmark.
Wow.
So
That's
95% of active strategies, you say, they underperform S&P 500. So if somebody has got taken position only in S&P 500 in US,
mm.
they would have beaten 95% of funds.
That is crazy.
Yeah.
But and
And
you're saying this is a inevitable, market reality
as
that
markets
happens.
become mature, this is inevitability. We are talking about you are talking about a scenario that cannot be avoided. So what can happen like in mid cap and large? So initially alpha disappeared in large cap.
Mm.
Okay, then it started to disappear in mid cap at the end of last decade.
Mhm.
Okay,
In the
so
2010s, you
in
mean?
the 2010s, so some 250 for 250 companies coverage has increased and they are in radar of everybody. Their share has increased in the client portfolios and everything. So a
Right.
lot of participants are there. Now we have come to small cap space. Small cap space is quite large. It's around 5,000 companies. Okay.
Right.
So alpha might not truly disappear forever. there,
Right.
because it might not be possible to cover all of these companies efficiently and optimally
Mm-hmm.
to take care of all the developments, to
Right.
adjust for all the development. So their alpha might be there. So there also our time coverage would increase,
Mm-hmm.
but at a slower pace. So even in US today, 70% small cap funds
Mm.
uh, underperform their benchmark.
Right.
But success rate for in small cap space is higher.
But then so is the risk.
So is the risk, because you are now entering into a most riskier zone of the market. So you will keep going in search of alpha. You will keep going for smaller segments.
Right.
So for small, you will move to micro cap. Okay, then you will do ultra micro cap, and so on. Okay,
Where the exploitation might still be
still be
possible.
there and
Right.
coverage is less.
Yes.
Okay, so you would
Yes.
go there. See, if you look at the US experience,
Mm.
okay, since 80s, active funds were failing in creating alpha. Okay,
Right.
and there we saw the rise of quantitative rule-based quantitative factor investing.
Okay.
Okay,
Okay.
so there they build the portfolios around popular factors like quality, momentum, alpha, low vol, dividend, value. Okay, concentrated portfolios, basically diversified portfolios concentrated in these particular factors.
Right.
Okay, so this is the basically foundation of quantitative factor research. Okay,
Okay.
so these portfolios were typically used to create additional returns on the top of the market.
Okay.
So alpha strategies, alpha slice basically move to this segment,
The factor
the
segment.
factor segment. Okay, the quant segment. If you look at the Indian markets, if you look at the applicability of alpha in Indian markets, okay, in NSE has introduced some indices
Mm-hmm.
which are there.
Mm-hmm.
Okay, if you look at all of these indices, they're covering many factors across different segments like large cap, mid cap, small
Right.
cap. Literally every single factor has created an alpha for investors over the benchmark. Okay, in last 10-15 years.
Right.
Okay,
Right.
so factor alpha is present in Indian market as well.
So would it be right to say that instead of just investing in, say, in the broader market ETFs,
Mhm.
even if you were to invest in the Nifty factor indices, you will still outperform the
Yes,
market
still outperform. So so learning from Indian experience in Indian market, what we have done, we have
from
basically
the
done
US market, you mean?
Indian market. Basically, US market was already there. All the literature and kind of strategies were there, but there was also some basic research done on Indian market.
Okay.
Okay,
Okay.
so alpha presence was there.
Mm.
So to fine tune that alpha for
Mm.
investors, what we have done a research spanning over 20 years. Okay,
Mhm.
across 500 companies, covering somewhere around 500 parameters. Okay, and
Okay.
there we have identified the winning factors. Okay, which can create alpha for investors in the long term. And then the portfolio, then we come to portfolio construction process, where we have created the portfolios. We basically use this research to
Mm.
design rules
Mm.
and create the portfolios,
Mm.
okay, that capture those winning factors and can deliver higher risk adjusted returns to the investors.
Got it. Got it. Got it. But also there is this whole caveat of not all factors doing well in all market conditions, right?
Mhm.
There is that rider as well,
Yeah.
which one needs. So it is not like if you just put your money in the Nifty factor indices and you can just expect things to work out.
See, different factors work in different cycles, like low vol, dividend, quality. They typically work well in alpha expand.
Mm, mm,
Let's say the alpha expand more
mm.
in bear market. Let's
Right.
say BRO market consolidation phase. So if you take a look at the high risk factors like small cap, momentum, alpha, even a slice of, you can say, value,
Right.
that typically expand during the bullish phase. Alpha expands in bullish phase.
Okay.
Okay,
Okay.
so different factors work in different market conditions. So if you are there for, let's say, 15-20 years,
Mm.
okay, there would be multiple market cycles, and you
Correct.
will end up with alpha.
Right.
But the problem is that investors are mostly there for 3 to 5 years. After that, they lose patience.
Right.
Okay, and
Right.
they exit. So, for example, let's say in 2007, you enter into momentum strategy that is designed by built on NSE index. For 7 years, return would be 0%.
Right.
Okay,
Right.
so there's timing risk with factors if you're investing for 3 to 5 years.
Right.
Okay,
So if I
so
were to
yeah,
summarize this,
yeah.
okay, if I were to summarize this, just
Mhm.
correct me if I'm wrong anywhere. You're saying the reason why the alpha is disappearing from active style of investing is because this is an inevitable reality as a market matures,
Yeah.
right? Because there are multiple reasons like,
Mhm.
coverage of stocks increases, computational power increases, retail participation
This
increases.
has happened in US, Europe,
Correct.
Japan.
Right.
Okay. And there is no reason why it would not
It will
happen in
not
India.
happen here. So now to fix for that,
Mhm.
again learning from these developed markets, one of the very data driven
Mm.
models that has worked
Mhm.
is depending on these factor based
Factor based.
approach,
Yep.
right? There also, however, while there are nifty factor indices, there is also the timing risk when it comes to factors, because
Mhm.
not all factors work in all
Yes.
market conditions, right? And that is why, in a nutshell, if I were to say, while we also do factor investing,
Mhm.
that is where our tactical quant model
Mhm.
rotates those factors depending on the market conditions,
Yes.
right?
Yep.
Okay. In case any of you are really interested in understanding our approach a little bit further, to know how we do it and how we are able to deliver the sustainable all weather alpha that we aim for, then you can click on the description. There is a link which talks about RPMS specifically. Thank you.